Hello everyone, this is Phil at Laptop Trader channel on YouTube. Welcome to our community. Here's my email contact, laptoptraderphil@gmail.com if you have any questions or comments. Caution, most stock traders lose money. Please protect yourself at all times. Nothing discussed in this video is trading or investing advice. This channel is for informational purposes only. And thank you for being here. Here is our agenda for August 2023. The first half of the video this month will be on money and trade management. This is very crucial to any business success, even more so in the markets as there's a high failure rate for new traders. So that's going to take the majority of the time in this video. And then on the second part of the video, we're going to go into the topic, which is advanced, of selling covered calls for premium income and to drastically increase our returns at the same time reducing our risk and having the market pay us to do so. So that'll be our topic towards the end if you want to stick around for that advanced topic. And then next month we'll discuss the opposite of covered calls, which are called cash secured puts or naked puts. This technique or strategy allows us to name our price on stocks that we wish to own. So that's what's coming up next month. So look forward to that. Again, you're welcome to watch, like, subscribe, and share with your friends or family this channel. So first we're going to do a little bit of a review for new traders. So this is just how I look at the market. And this is something I include in every video. This is just kind of the four market stages of price action over time. The green line would be kind of like a moving average of that price over that time. So I'll leave this here for a few seconds for our newest members. And this is just kind of the names for the different four stages. So you've got accumulation, stage 1, stage 2, greed, stage 3, distribution, and then stage 4, fear. And then many times this cycle starts over or companies go out of business. This is what these stages would look like in reverse after a major downtrend. Then for new traders, new members, this is just how I look at price. These are price candles or price bars. It's just called a candlestick chart. This is how you would read the candlesticks. So I'll leave that there and you guys can review that. This is what on the chart I would refer to as a pivot. This is how we define a pivot, mainly on a daily chart or daily time frame. Pivot high would be a high bar with 3 lower bars to the left and right, and a pivot low would just be the reverse. It'd be a low bar with 3 higher bars to the left and the right. So that's what you would see on a chart as a pivot. That's how I define a pivot. This is one of the main buy setups that I look for. I call it a 3-bar turn, or 3-bar turnaround. A lot of times I will abbreviate that as a 3BT, and I mark up my charts. So I'll leave that there if anybody wants to read through that. That mainly works in an uptrend. So you really don't want to take that setup in a downtrend. That's kind of one of the things I really look for. Next, this would just be a quick example of how I would use that setup to do an entry and where I would place my stop loss order and how I would look to control my risk, as that's one of the topics for this month is risk management. So what is risk or trade or position management or money management in trading? So that's kind of what we're going to get into this month. It's simply the amount of risk you're willing to take on any single investment or trade or position. We're going to look at how can we reduce our risk in addition to any general market investment risk. So there's always risk in life. There's always risk in the markets. There's risk if you put your hard-earned money into, let's say, a total stock market mutual fund through your job, and the market, is going to go up, but it's also going to go down during certain periods of time, like we saw in 2022. So how can we reduce risk outside of that if we're going to trade in individual companies or individual securities? So if you're in a pension or a 401k or an IRA or any other investment with a mutual fund, then you're most likely not in control of these decisions, as these are considered long-term or lifetime investments. And you should know and expect to ride the market up and down until you need the money for future expenses. These investments are generally tied to the overall market risk and overall market returns, and generally offer diversification over a broad mix of stocks and or bonds. The idea is that over time the market has gone up and should continue to do so, thereby giving you a return on your investment. So, continuing on, the market does not just go up in a straight line, and there are periods of correction or price declines for the overall market indexes, like the S&P 500. Individual stocks regularly go up and down and sideways, and even gap up or down wildly on events like news or earnings announcements, government reports, Federal Reserve announcements about monetary policy. So you must protect yourself against this volatility. This is generally not something you will or can do in a stock mutual fund investment. So that's done for you. The only real choice you have in a mutual fund investment or 401k investment is how much you put to the mutual fund and how long you want to own it. And basically, the mutual fund management takes care of the day to day and week to week buying and selling of investments within that mutual fund. So that's kind of out of your control. So as an individual stock trader, I like to have a little more control. So I'm going to give you 3 basic ideas to limit your risk on any single trade or any individual stock investment. These rules apply to any account size and any level of experience in the market. Your previous success in any other industry, regardless of title or degree or status, do not matter in the stock market. It's a different quadrant with different rules, and the risks are real. This is not like being an employee or running a small business. And this is not going to be a comprehensive, um, you know, these are only 3 basic rules. There are other rules you can do when it comes to money and trade management. So these are just 3 basic ideas, okay? So rule number 1, first and foremost, have a trading plan. Now this rule may seem like an obvious one, but most traders lose money and have no clue as to how the market works or how to make money trading stocks. So we only make money in stocks a couple of ways, mainly through price movement, right? Prices, you buy a stock at a certain price and the price goes up, and then you have a gain, you sell the stock and you take your gain. Or if you're shorting stocks, you can make money on prices moving down. That's the 2 main ways you're going to make money on stocks. Being a professional level trader or investor is in a different quadrant than being an employee or a small business owner or being a corporate manager. These professions all have certain skills that apply, and so does being an investor or trader in individual securities. You will need to get educated and informed on the stock market to succeed. This video series should be a small part of your journey. This business has a very high failure rate and should be considered risky, like owning a restaurant. How many times have you seen on TV when someone decides to jump into the restaurant business and fails? They had no clue to the hard work or the pitfalls in running that type of business. The same is true in stock trading. Well, the good news is it doesn't have to be that risky. Please use some common sense and have an idea or a plan before you ever push the button and enter a trade. Stick to stock prices you're comfortable with, like less than $50 or less than $20. When I started, my first trade was Ford around $8. I think I maybe traded 10 shares or 5 shares, so it wasn't a huge jump for me. Stick to companies with some value and or profits or potential profitability very soon. I would avoid penny stocks, IPOs, and the biotech sector at first. These areas are generally more risky. Try trading in companies that you understand their business model, like Uber. All right, it's pretty simple. Push a button on an app and driver shows up to transport me from A to B. So that's pretty easy to understand what Uber does, even if they don't make money. You do not have to trade or deal in junk with a poor business model or an idea that is way too weird or that you can't explain or that is not close to being profitable. Wall Street pays up for growth or growth in the future. The market is an auction style forward pricing mechanism that discounts today's price for future appreciation and growth. Growth, growth, and more growth is the favorite word on Wall Street. Spend an hour and research your potential trade or investment as to what are the prospects for growth in sales and revenues. Is the price chart in stage 1, 2, 3, or 4? Is the price moving up, down, or sideways? What time frame is your bias direction and what time frame are you going to trade in? These are questions you really need to answer before ever pushing the button. So that's just a basic for rule 1. Come up with a plan, and then rule 2, limit your position size. I call this my gap rule. So basically, you can't lose what you don't put at risk. Decide now before you enter any trade what is the maximum dollar amount you're willing to lose in any single trade. Only use a certain dollar amount or percentage of your account balance. This rule will help protect your capital against the unexpected and gap risk. This will protect you regardless of your account size. Think about what can you sleep with if your stock investment gaps down or declines significantly in a short period of time, or even goes out of business or goes to zero. Several recent examples, like SVB Bank, which went out of business in, I believe it was March. PayPal had a recent gap down. GE had some problems several years ago. Heinz Company, for some reason, they had accounting errors, just making catch up. Enron was a huge Wall Street favorite, and then one day it was out of business. MCI, similar problems. Lehman Brothers got caught up in the financial crisis, taking too much risk. GameStop, right, investing in a retail game company that didn't make money. And Melvin Capital shorting GameStop, which got caught in a short squeeze. All of these are examples of people taking too much risk and having too large of a position in any area, or even being crooked in the case of Enron, and I think MCI too. If we use an example of a $25,000 account and you are an inexperienced trader, so we could start small with, let's say, a $100 or $200 trade position. Even $500 is only a 2% of your account. Just adjust this amount for your account size and your experience level, not your ego. The idea here is to limit your capital at risk because you will have losing trades and things don't always go as planned. If you risk $100 maximum per trade, in our example, you could take up to 250 losing trades in a row before being out of money. If you risk $500 per trade, you could have up to 50 losing trades in a row. If you are new, you may have 10 or 20 or more losing trades, and it takes significant gains to recover your losses. So if you have a 50% decline in your account, it actually takes a 100% gain just to break even. So if you think about it, just use the basic number like $100 and you lost $50. Now you have $50 left. You're going to have to double that $50 just to get back to your original $100 capital. So again, this is why money management is so important. I use this rule myself as a non-negotiable part of my trading plan, as I have experienced many times intraday or overnight gaps in my stocks. It happens all the time. As you progress and your trading becomes better, maybe you analyze companies better, your price analysis and chart interpretation improves, and you start to see some success, you can stay in the game and slowly increase your risk as your account size and your experience increases. Many traders choose not to hold stocks until like the day of earnings for this reason, as that is a main event for a company. Gaps happen in and around earnings. And finally, another basic rule of my plan is use a stop loss strategy to further limit your risk and share size your trades. This number will be an amount figured out per trade, even if you only own 1 or 10 shares. Stop loss allows you to share size for your level and limit your risk to a dollar amount beyond Rule 2. This will allow you to stay in the game, gain experience, and gain some confidence over time and not blow up an account. By using a stop loss, you further limit your downside loss potential. Caution, if the stock price gaps below your stop loss, you will get stopped out at the lower price it gaps to, which is, again, the reason for Rule 2. We're going to choose a low number here, especially if you're a new trader, like 10 bucks or $20 per position. And here's an example. Okay, if XYZ opens at $42 per share during the day, has a range of $38 to $42.50, and you had a stop order at $39, the computer at your broker would have stopped you out from losing money at or below $39. If you had 10 shares purchased at, let's say, $41, you would have a loss of $20 for this position. So you'd have a $2 loss, 41 minus 39 times 10 shares. So that would protect you. If you had paid $41 per share, you would have a risk or risk value of $2 per share in this position, referred to as R or RV for risk value. Now you can share size appropriately for your experience level. If you're a new trader and want to limit your risk to $10 per trade, how many shares can you buy based on rules 1 and 2? Actually, that should be rules 2 and 3. Apologize for that. $25,000 account times 2%, 5%, 10%, or what fits your risk level? I don't know. But let's use 1%, okay, or $250. So $250 maximum trade position or maximum we can lose. And a risk value of $10 because we aren't 100% sure of direction, but we think based on our chart and our homework it will go up, or we expect the price to go up and appreciate. So Rule 2 says we can buy $250 maximum of any stock. Divided by 41 per share means we can own a maximum of 6 shares. Rule 3 says we can buy up to $10 worth of risk value. And if our stop is at 39, we divide 10 by $2 stop loss. So in that case, we could have a maximum of 5 shares. So these two rules will protect you from doing serious damage to your account. If the stock price moves up, we can then raise our stop and add shares up to our maximum allowable total position risk. So we will look at some examples of this, okay? So I know there's a lot of words, but these are 3 rules that have saved me time and time again. So here's an example of Uber. So recent chart, this is a daily chart, I believe it's 6 or 9 months. So I just put an arrow there of a possible entry point. I didn't take this trade, but we can see there's a kind of my 3-bar chart set up there. We have a red bar, kind of a green bar that went down but closed towards the middle of the red bar, and then the next bar green kind of went towards the top of that first bar. So that's kind of a little 3-bar buy set up there, and then after that it breaks out and breaks out to the upside, right? So you guys can see it then starts a new uptrend. And that 3-bar buy setup happened after this gap up on earnings, and then went sideways for about 3 weeks. So I felt that would have been a possible good entry on Uber. So we would have entered by $38.15 per share and maybe put the stop at, let's say, $36.75, according to the chart. We would have a risk per share of $1.40. And then we would then share size based on that $1.40 per our plan. So you just adjust that for your risk, for your experience level. As price moves up, we can look for targets of 1R or 2R or more. So a 1R move would be, our entry price, $38.15 plus $1.40, which would give us a first target of $39.55. If we wanted a higher target, let's say we went 2R, we could have a target of $40.95. So to me, that seems reasonable on a $38 stock. 2R would be a 7.33% gain. As you can see, price almost hit $50 on this chart towards the next earnings date, towards the top right of the chart. So we could have trailed our stop loss up based on pivots, which you can see some pivots here. There's several examples here. Here's a pivot, right? Here's a pivot. See these pivots. Here's a pivot. When we entered here, that would have been a pivot. This red bar here would have been a pivot. Then we would have had the next pivot would have been like over here. Could have raised our stop there. So that's how we use pivots. So we could have trailed our stop loss up based on pivots and price analysis for a nice gain with very little or almost no risk after we raise our stop. Again, a stop loss will not protect against a large gap down. So that's just one quick example of how to use some of these rules. Here's an example of a trade that I did take. This was on Trade Desk. Closed the week at 84.84. I had an entry back in late May, or maybe the first week of June. I think it was late May. I entered at 65.15. I placed my stop under the previous pivot. There's nothing saying you have to do that. I sometimes do that in case the stock retraces on me so I don't get stopped out. That's where I chose to put my stop. You could put it under the bar you entered on if you wanted to have a tighter stop. But I chose that. I felt that was reasonable, $1.15 stop loss. So later on, several weeks later, when it went up, consolidated for like 3 or 4 weeks, I finally got what I was looking for right here, this large green igniting candle or igniting bar. And once this bar came in, I immediately raised my stop under that bar. So I entered 65.15. That stop was somewhere around maybe 78 bucks. So when I raised my stop, I kind of locked in a profit. And then only 2 or 3 days later, I decided to exit when I saw these two topping tail bars. I figured, well, that's probably the end of the move. I exited at 85.45. So I entered 65.15, exited 85.45. I had over $20 per share gain on this simple trade. Didn't risk a lot, didn't take any unnecessary risk, and was able to get out there near the high. And so I was happy with that trade. So it's just an example of how I would use these rules. So let's review our 3 starting rules or starting points for some sort of risk management. 1, get educated. Read some books. Watch other videos. Get interested. Do not take my word or anyone else's word for what is a good trade or investment for you. Do some homework. Develop a trading plan tailored to you and your budget, your account size, and your experience level, and your risk tolerance. This is going to take some time for you to work out. It's not going to happen overnight. It's not going to happen after watching a couple videos. Establish your maximum loss limit per trade as a percent or amount of your overall account size, not your ego. Again, what can you sleep with at night? 3, consider using a stop loss order strategy as a dollar amount per trade to further limit your mistakes in case you are wrong on direction at this time. Share size appropriately per these 2 rules will keep you out of trouble. Finally, the stock market is a very risky and losses will occur. Intraday rallies and sell-offs occur regularly. Gaps up or down occur regularly. Protect yourself at all times, just like a good fighter. A good trader may only have a win rate of 30 to 60%. So good traders don't win all the time. A really good trader may win 70% of the time. A really good options trader may win, 85 or 90% of the time, but nobody wins all the time. So after I learned some of these techniques to reduce risk or control risk, I then thought to myself, well, how am I going to make money? So this is the next question that came into my mind when I started down this rabbit hole several years ago. I had been investing since around the year 2000. I didn't even know anything about limiting risk or using stop losses. In fact, I first started buying cheap options and gave away some of my hard-earned money to the market in a short period of time. You are going to make money by limiting your losses to some amount you can handle until you gain experience. You're going to add to your winners up to your maximum allowable risk amount. Then when you have a winner, you're simply going to trail your stop until you stop out at a profit or exit the trade yourself based on some sort of reasonable target price. As your account balance grows and you master the basics, you will naturally increase your dollars at risk over time. However, you'll keep your risk ratios the same. What will happen is you will grow more confident in increasing your RV over time from, let's say, 10 to 20 to 30 to 50 and so on. You will simply buy more shares based on your experience level. This was a game changer for me, okay? So it's something that I felt I could do. I was no longer scared of, you know, buying an expensive stock or buying a cheap stock or even buying a stock I knew nothing about. So you're going to also need to have some key things to track to being profitable so you can keep track of your progress. So what are your criteria for entering and exiting a trade? I've given you a few of my criteria already. My main criteria is a buy setup or a breakout in an uptrend or a new uptrend. What is your win-loss ratio? How many trades are winners and how many are losers? This will take time to develop. I would say at least 100 or more trades. What is your average loss and your average win? Again, you're probably going to need 100 or more trades to figure this out. This is going to take some time. You should have more winners than losers, and your wins need to be larger than your losses, or you will run out of money. Depending on how good you are, you can have more losers and still make money in the markets. It comes down to risk management. Track your progress and keep some stats on yourself. This is your gig, and it is up to you. I use a simple spreadsheet for tracking, and I write down in a notebook my game plan for the upcoming week. So my trading plan is very simple. I do my homework on Saturday or Sunday. I decide whether I'm going to enter or exit any potential trades. I have a list of trades, potential trades I'm looking to enter. And then most of the time, honestly, I'm just managing what I already own. Because you only want to have so many trades at a time anyway. I try to keep mine under 10 and maybe have an option trade in there, a covered call, or an option spread or something to keep my mind working. But anymore, I do more management than I do entering and exiting, to be honest with you. So our closing, closing out our discussion on risk. When I learned of this strategy or technique, I immediately thought I can do that. I can keep my day job, trade on the side, and not be scared or lose sleep over my trading and stock investments outside of my 401k account. Because I had personal money management and a budget, I could now just add a line to that budget for trading, and that is exactly what I did. So I had responsibilities when I got into trading. I had a wife, kids, house, car, full-time job, other responsibilities. I didn't have time to really mess around, to put it the easiest way. I'm not a day trader, and so I don't just sit by the computer. I had to figure out something that worked for me. Again, my first trade was about a $10 risk value on about an $8 stock. Now, you do not have to use a stop loss if you do not want to. However, I think you should still limit your risk overall using Rule 2. Let's say you're a big shot and you know what you're doing or think you do. So let's use an example. Okay, Apple closed the week at about 182 per share. If you simply use Rule 1 and Rule 2 and you have a $1 million account size, you could still limit your trade to, let's say, only $10,000 of Apple stock and still have 990,000 left over if it went to zero. So you would only buy 55 shares, thus limiting your risk up front. Make sense? Here's just I guess, the diagram I tried to draw a while back. This is from a previous video. It just shows kind of the risk to reward based on where you place your stop loss. Okay, so I guess it's not the best diagram, but I'm not an artist. But if you bought on this candle, this green candle right here that I just circled, and you placed your stop under that candle and you entered somewhere on that candle, let's say towards the high, okay? And you would have a $1 risk value. If price moved up to here, to this first black line, you would have a 3-to-1 reward if you sold. If you allowed it to increase in price and you sold this next line, you would have a 6-to-1 reward. If you let it go higher and you let it get all the way up to $60, you would have a 9-to-1 risk to reward based on your risk, not on your purchase price. Okay, and then on the right side, I try to draw, if you used a bigger stop in case the stock kind of retraced on you and you want to give it some room to wiggle, so to speak. So in this case, on the right, you would use a $4 stop loss. So using that same stop, if price went to this first line at 55, you would have a 1-to-1 risk to reward. Got to the second line, somewhere maybe around 57, you'd have a 2-to-1 risk to reward. So this is just showing how risk to reward can vary based on entry, stop loss, and then maybe later on raising your stop or adding shares later on. Okay, that's all I'm trying to show with that chart demonstration. I will leave this up here for about 5 or 10 seconds and take a drink. You guys want to read through that? Okay, you guys can pause that if you want to read through all that. Let's get to the next slide. So let's look at a few more charts to make a point on risk. This is a simple daily chart, 6-month chart of company block, symbol SQ for square. And we can see looking left to right that it was in a downtrend. And then you can see some of the gaps in here. Here's this red bar here where it opened and closed lower, then gap down. Here's another bar where it was red, gap down significantly. Here's a gap up where it opened here, closed here, and then gapped up. So there's gaps happen all the time on these stocks. And when you analyze these trends, you can see the gaps, you can see the trend, you can see how it was in this downtrend, it kind of went back up. Looked like it was going to break this resistance area here with this purple line I said, this light purple line. And that was just a look back here at block, just to show you how often these individual companies gap up and gap down. So it even gapped right here, it gapped down, right? It closed here, gapped down, and closed down. Next day, it gapped down again a little bit and then closed higher. So gaps happen. Okay, so use caution. Here's another example of PayPal. So over here, we had an earnings event. The day after earnings, we had a significant gap down from maybe 75.5 to, I don't know, somewhere under 69. Closed the day at 66, so that was a pretty significant gap after earnings. That started kind of a little mini downtrend, kind of changed to an uptrend. This is one that I got in. And then over here, again, we had earnings. The day before earnings, we had a gap down. The day after earnings, we had a gap down. So, gaps happen many times around earnings, or even day before, or day or two after earnings. So, just wanted to show you this to give you guys maybe a reality check as to what can really happen with these individual companies. Not everything is as smooth as it may seem. Here's an example of Apple, right? So even the largest company in the world, I think, or one of the largest companies in the world, recently, in August, had a gap down the day before earnings and the day after earnings, a significant gap down next day. So I also drew on here just some basic pivots, maybe where you could place a stop if you were in the trade, to try to help protect yourself. And then I just used 3 moving averages showing the uptrend. I used the 20, the 50, and the 100. You can see it's a pretty nice uptrend on Apple, but day after earnings, it gapped down. So don't use these moving averages either as support or resistance, because you could see last day of the week after earnings, prices gapped down and closed down below the 50-period moving average. So just something that kind of defined these trends. There's another one, SVB Financial Group, or SVB Bank. They had earnings back in January, and by March they were out of business. So this was one of the largest banks. March 23 went out of business. Gap down from 276, and then the next day it closed at 106.04 and was out of business in one day. So again, if you're a big shot, you may think, well, I know what I'm doing. Well, if you're an SVB bank, I hope you didn't have all your money in an individual bank, because banks also can go out of business no matter the size. Here may be just a few books to consider reading. I'll leave that up there for 5 or 10 seconds. You guys can read through that, or pause the video if you want to read through that. There would be maybe a few web channels that I like to watch, or web channels for you to consider that I find credible. For me, those are kind of listed in kind of my favorite to other ones that I consider that I like to watch. I really like at the bottom the Chat with Traders podcast. If you happen to be driving around, that's an interesting podcast to listen to. I think he's got, I don't know, several years now of podcasts. Just have a discussion with real professional traders. And the one common thing you'll find out with all these traders is risk management. They all use some sort of risk management. Okay, next. So that's going to end our discussion on risk management. And we're going to go into an advanced topic now. If you're new, you're welcome to stick around. If you don't understand it, that's okay. Don't be intimidated by it. I'm going to go into how to sell covered calls, or do a buy right and create a covered call. They're the same thing. A covered call is an option strategy, is when you own 100 shares of stock that has options available to sell against that stock. You'd sell one contract against your 100 shares that you own. One call contract would equal 100 shares of stock. Your shares cover the risk of the call option. You're covered. Just selling a call would be an unlimited risk position, and your broker is not going to allow you to do that. A buy right is the same, but it's done simultaneously at the time of purchase. You would purchase 100 shares and simultaneously sell a call against those shares. So that's the only difference between a covered call and a buy right. It's the same thing, in case you see that term on your broker's platform. We are going to use price charts to determine a good place to implement this strategy. In general, the faster price appreciates, the more premium we can sell per share. And it's even more, I guess, exaggerated if you get significant gaps up. I'll show you that here in a minute. In a flat market, this also works to try to lower our cost basis over time. Also, in general, we are going to use an at-the-money, or more likely an out-of-the-money call strike price. So I'll define that for you. That's easy to understand. The strike price is the price that you choose to sell your shares at. So you have several choices: to sell a call or not to sell a call, to sell an option in the money, at the money, or out of the money. And then you get to choose, where you would be willing to sell your shares at. So basically the parameters you need to be approved to sell options, and you need to have at least 100 shares of stock to do this strategy. So let's talk about some risks and rewards of selling calls or covered calls. This is beyond having basic risk management. There are two main risks of selling covered calls on stocks we already own. Again, minimum of 100 shares to implement the strategy. One option contract represents 100 stock shares. Strike price is the price we agreed to sell at in exchange for the premium received. So that's why they're paying us to do this. We're agreeing to sell our shares in exchange for a premium. So the main risk in this strategy is stocks. Let's say your stock sells off under your cost basis, under your strike price, and or goes to zero. This is the main risk and is the exact same risk as if you own the stock without selling calls against your position. So you're not taking on any additional risk when you sell a covered call. It's the exact same risk as just owning the stock without selling a covered call. With the stock, you can implement a stop loss to guard yourself against going to zero. Stock, the second, perceived risk is that a stock gaps up or increases significantly in a short time, like an earnings gap up or down. A gap up really is not a risk, as your call option sale generally should be out of the money, not always, above your purchase price or cost basis. So if you had a stock that was $5 or $10 and you sold a call that was 15, that would be out of the money. If the stock gaps up over your strike price, you forfeit the gain over your strike price. So it's not really a risk, it's more of a perceived loss and gain than anything else. Okay. So let's talk about some rewards of selling covered call premium. And I'm going to give you a real example that I did of later on. So one, you can get income from your assets that are already in the market, essentially renting out your shares for a premium. Options were derived from basically like an insurance policy, so that's why they call it premium or premium income. Two, not waiting for the stock or the market to move higher to get a return. So you can start to get a return without the market moving higher or your stock moving higher. You can start selling premium. Increasing your returns over what the market is giving in price alone. Reducing your cost basis and reducing risk. The ability to significantly increase your returns in a short period of time. You're also able to wash, rinse, and repeat this during the year. You can sell weekly calls, you can sell monthly calls, you can go out 3 months or 6 months. There's a lot of choice in how long you want your call to stay open. If your shares are in the money on or before expiration, you should have a locked-in profit the minute you enter the trade. Okay. In other words, I'll show you that my example where I had stock around $10, I sold the $12.50 call. So I'm agreeing to sell my shares at $12.50 that I only paid $10 for. So in that case, I essentially have a locked-in profit unless the stock drops significantly. Again, we're going to use the charts to look for a stock that's in a sideways trend or an uptrend, or even a stock that gaps up to do this trade. You're able to sell premium during different stages of the market cycle for varying amounts of income. So the premium is going to vary based on the volatility, based on how high or how fast it's moved up. Is in a sideways trend. There's a pretty significant difference in premium during different stages of the market. You can be as active or as passive as you want to be with this strategy. Again, you don't have to do this, but it's a way to increase some income and increase your returns on stuff you already own or stocks that you wish to own. So quickly, what is out of the money or in the money? So in this example, on this chart, Apple closed at 181.99, just under 182. In the money call would be anything below 182. Any strikes below 182 would be considered an in the money call. We're going to try to sell out of the money calls. Any call above 182 strike price will be an out of the money covered call. So in this picture, you can see Apple's been in this nice uptrend. All of a sudden, earnings come out. It's kind of flat up here, and it gaps down. If you sold that call, let's say 2 days before earnings here, you probably could have sold very easily a 200 call or higher, and taken in a significant amount of premium going into earnings. And 2 days later, you could probably close that call for, I would say, at least 50% gain, because with that type of gap down, the volatility is going to, and the price movement down is going to reduce the cost of that call. So essentially what you're doing is you're selling a call at one price against your shares, and then you would buy to close at a lower price. So it's a little bit different than buying low and selling high. Essentially you are selling high and you're going to buy back low, or let the call expire on the future expiration date. But this would be a good example of selling into earnings, a covered call. If you think price could drop, taking advantage of that. Again, nobody knows that the stock is going to gap down like that for sure, but it's sure lately it seems to be the norm versus the exception. Stocks are gapping down after earnings. So that's just an example of out of the money or in the money. That's not too hard to understand. Here is a picture of a chart of Upwork company, symbol UPWK, that I have been selling calls against since April 26th. April 26th, I sold a $10 call. I owned over 100 shares. The time price was around 9.5. So at that time, I decided to sell a $10 call, which had been out of the money, took in some premium. I bought to close that call about a week later on May 9th. Sorry, more than about 10 days later on May 9th for a small profit. I'll show you this in a spreadsheet. And then on May 23rd, a couple weeks after that, I sold another $10 call when price was down near maybe $8.50. So that would have been $1.50 out of the money. Sold another $10 call, took in another premium. And then on July 14th, I rolled my $10 call when price was getting up near $10 again. I rolled that out to August. So I have August 18th, $10 call against my first trade. So I took in 3 premiums in several months. Then I also decided to a buy right on the same day, where I bought 100 shares and I wrote a call way out of the money at $12.50. And I took in premium on that trade. So both of those expire August 18th. Now, the last 2 days, price after earnings has significantly gapped up and closed Friday at $14.80. So now if price stays above $12.50 and above $10, I'm going to be called away. My shares will be called away. But we'll see what happens. We've got another couple weeks to go on the trade. And I don't care if it gets called away because I already took in premium. I know my cost basis, and I'll show that to you guys. There is one thing I want to caution you about when it comes to accounting for a covered call. I don't know if this is something with my broker, but this shows on these 2 calls I have. You can see right here, there's Upwork shares. We've got the August 18th 10 call, August 18th 12.50 call. Here is the credits I took in for those calls. I took in 88 cents on the 10 call. I took in 40 cents on the 12.50 call. You take those times 100, and I took an $88 and $40. So everything in options is always times 100. But the broker shows that today's price on these calls, the one is 470 and the other one is 236. So that's showing a large unrealized loss. You guys see that? It's showing a $392 loss and just over $200 loss, and some very large percentages. That's unrealized. That's if I was to buy back to close those calls today at the market price. But it's unrealized, it's just accounting, so don't get freaked out by that. The numbers would be accurate if you bought to close the call at that time. So, but with a gap up in stock price, that accelerates the value of the calls that much. So, but we don't have to do that. We just hold on our call onto our position until August 18th expiration and see what happens. Regardless, we still keep the premium. And if our shares get called away, they'll be called away to profit. We knew that entering the trade as a possibility for collecting premium, agreeing to sell our shares at a certain price. Okay, so it's part of the game. I just want to caution you guys on that. Oh, so let's keep this chart up. That was the last slide, sorry. I'm going to now go live to my spreadsheet. So take a picture of this in your mind, right? Upwork in kind of a slight downtrend. Here we had this real nice green bar on volume after earnings. And since then, prices went sideways and then gapped up. Looks like a new uptrend, right? So keep that in mind. Go to the spreadsheet now, and let's take a look at what did we accomplish. So first I want to show you the amount of premium I'm able to sell. Okay, so some of this will be confusing. I'll try to keep it simple, but here I had a losing trade. This was a credit spread. I ended up closing that for $1.60 loss, right? So going down here, I've got these basis numbers is where I started selling covered calls, right? I sold one here for 52 cents. I bought the close at 5 cents, so I took that gain, difference between those two numbers. Then I sold another call for 20 cents, took in a credit. So these bases are just trying to, for my own accounting, to see could I get that money back from that losing trade. As I go down, here's another one where I did the buy right for $10.42 back in July, where I bought 100 shares and sold $12.50 call out of the money. And then again, I rolled this 10 call also in July. I took in 71 cents to do that. So over this period of time, I was able to reduce that loss to only 22 bucks. So that is something you can do, selling premium. But don't worry about that. That's more for my kind. Let's take a look at here where I just put together this for you guys. Try to highlight some. There's different ways of accounting, okay, when it comes to these positions. But here you can see there's a new uptrend. So I bought 200 shares, lowered my cost basis on 200 shares. So it's important, again, because of the way the broker accounts for stuff, you need to keep track. Otherwise, you get freaked out when you see minus 329% on your brokers. This is why I keep this spreadsheet. So I know my cost basis. Okay, so first of all, on the first trade, I bought the shares and sold the 10 call. I've taken in $1.48 in covered call premium, which gives me a break even of $8.52 for the first trade. So I'm not worried if my shares on the first trade get called away at 10 bucks because I have a locked in profit. Okay. The other one, if we take a look at the second trade, if called away at 12.50, I have a 10.42 cost basis on the buy right. So if called away on August 18th, I would end up having a gain of just under 24% in about 35 days. So I think that's a pretty solid return, even if I own that for a year. 23.99% is a pretty good gain. Okay, so these are kind of returns you can expect with covered calls. Then we've got the first trade would have been about a 57.5% return in 90 days. Okay, depending on how you do the math. So to me, covered calls is something that I think you need to be a little bit better at math. Maybe something more for accountants, engineers, and nerds or whatever. But the math works out. So I have on 210 shares, I have an average cost of 10.87, and I have so much invested. The problem with the broker is they don't always account for the premium that you've collected. So my real cost average for my accounting is 949 for the entire position. That's all 210 shares. So whether I'm called away at 10, whether my other position's called away at 1250, I have kind of a can't lose trade at this point, unless the stock were to significantly go lower. So my cost for the shares that I figured out was $19.92 total dollars. Closing price Friday was $14.80 after the stock gapped up. I could immediately sell 10 of my shares because I have 210 shares for 148, so that would be a profit. On August 18th, if I was called away, I would receive $1,000 in for my shares. Also on August 18th, if I was called away, my other 100 shares would be called away at $12.50. That would be $12.50 back to me. If all the trades were closed, I would have a sale of $2,398 minus my cost of $19.92. Now, according to my broker, I would only have $115.30 profit, which still, okay, it's still profit. I'd have a 5% gain, just over 5% gain in 90 days, or over 20% annual. So I'm kind of forcing gain. I'm forcing a return. However, if we use my true cost basis, I'd have a profit of $405.10 after selling calls during stage 1 and into stage 2, which is 3 times the profit, just taking advantage of selling premium, right, versus not selling any premium. I would experience a over 20% gain in 90 days, or over 81% annually. We could also figure the gain based on our original investment of about 17.74% in that 90 days. So depending on how you look at it, you can kind of play with the numbers, do a few trades yourself, pick a stock that's maybe lower price or you're more comfortable with. Well, let's take a look at something else. If you had traded just the stock perfectly, okay, and bought the closing price of $9.97 on the day of earnings, which I'll show you in the chart, and sold on the close Friday at $14.80, you would have a gain of over 48%. But do we trade and time the market perfectly? I don't think so, right? So that statement is assuming that you did something really right back here, and you bought here. You bought here on earnings, at the low, $9.97, and sold at the high, or the close at $14.80. So there's no way to predict that. But what I can predict and take responsibility for is my own actions and sell premium against my holdings. So it's important that you keep track of your trades so you know your position and your cost basis at all times before you enter a covered call. You don't want to give your shares away for nothing. You want to make some money, right? So not only do you want to make premium, but you should also expect some sort of appreciation in your shares for doing so. Again, use money management to control your risk. So that's it. That's just kind of how I look at covered calls. I think it's a valid strategy. Again, depending on how you look at it, you can kind of play with the numbers for yourselves. And again, that's the end. That is the end of this month's video. Again, I'll put up my contact info. If you guys have any questions, comments, concerns, you're welcome to contact laptoptraderphil@gmail.com. Thank you for watching, subscribing, and sharing. We will see you in September. Thank you guys. Bye.